All right, let's talk a few minutes about pulling everything together. So, first couple of chapters, we learn what assets, liabilities were. So we know assets are anything of value owned by the business. We know liabilities are anything, basically the debts of the business. When we talk about liabilities, we're going to talk about notes payables, bonds payable, salaries payable, taxes payable. Of course, our key word there is payable, right? And owner's equity. Owner's equity is the owner's investment inside the business. We talk about two primary accounts underneath owner's equity. We talk about capital. Capital is when we have basically the business owner takes their own money, invests inside the business. That's going to be capital. And also retained earnings. We know retained earnings is a cumulative profit and loss since the start of the company. So it's basically all the profit and loss. What we've learned is that we learn journal entries, right? The journal entries, we do those, everything we do. Nothing exists, I mentioned before, nothing exists unless a journal entry is booked. We can have as many scratch pieces of papers as we want, but ultimately, in order for it to feed over to the financial statements, we have to book a journal entry. We know that assets increase on the debit side, assets decrease on the credit side, liabilities increase on the credit side, liabilities decrease on the debit side. Owner's equity increases on the credit side, owner's equity decreases on the debit side. 99% of the time we're going to credit revenue. The only time we don't is one time at the end of the month, and that's when we debit it. That's to close out the account. 99% of the time we're going to debit expenses, except for month-end close. We covered that in Chapter 4. And withdrawals. And withdrawals when you take money out of the business for personal use, and quite frankly, we won't see withdrawals. We could also swap out the word capital for common stock. Common stock is simply just selling ownership in the business, through just regular common stock. We'll cover common stock in future chapter, a little bit more detail. So we learn how all the accounts move. So we know we have to book journal entries for everything. Nothing exists without a journal entry. And we'll book every transaction we have, we'll have a journal entry. We know the debit always comes first. The credit is indented inch and a half, 2 inches underneath the last debit. Then we have a parenthetical explanation, just capture the spirit of the transaction, and we skip a line. And we learn we use all that information, and we come up with the account balances. Once we do that, we'll create our financial statements. And there's really 4 financial statements. We're going to create 3. Income statement, statement of change, retained earnings, and balance sheet. And of course, those are the ones that we're going to prepare in this, basically in Principles 1. Principles 2, you'll prepare a 4th one, which is going to be the statement of cash flow. But we really won't spend much time on that one in Principles 1. And of course, the income statement, they call it the P&L, the income statement. We've talked about the structure of it. It's going to be revenue less cost of goods sold as gross margin, gross profit. Then we subtract away all our expenses, selling expense, general administrative expenses, marketing expense. We'll have income from operations at that point in time. We back away taxes for our net income. Then we do our statement. That net income will feed over to our statement of change retained earnings. And we have our beginning retained earnings. New company is going to be 0, plus our net income that we just had back here, getting my ending retained earnings. Okay, that's my ending retained earnings. I'm going to use that then on the balance sheet. So on the balance sheet, we know it's going to be assets, liabilities, and owner's equity. We know the assets must equal the liabilities and owner's equity. We put the assets in order of their liquidity, which means that their ability to be able to convert it into cash. So we rank them that cash is always number 1, and then we can kind of go from that point. Liabilities, we break liabilities into 2 parts. We have short-term liabilities. So short-term liabilities are liabilities that will be converted into cash, or I should say will be able to be paid with cash within 1 year, 1 operating cycle, and long-term liabilities are going to be more than 1 year, 1 operating cycle. Underneath owner's equity, we have really 2 things. We have capital, could also be common stock, and we have retained earnings. And this will be the ending retained earnings. So the ending retained earnings will just feed over from our statement of change retained earnings. So our assets have to be equal to my owner's equity plus revenue. Assets equals liabilities plus owner's equity. No, my assets must equal to my liabilities and owner's equity. They have to balance. Balance sheets have to balance. If something isn't balancing, well, it means wrong. If something's wrong, then you should go back through and look over your financials. What I would do next is that we're going to do our closing entries. So we know that we have two primary types of accounts. We have temporary or nominal accounts, and they're income statement accounts. And we're going to force them to have a zero balance. And then we're going to transfer all that to income summary. Then we're going to take it one more step to retained earnings. And we have real accounts. Real accounts are balance sheet accounts, and you don't have to do anything with those. So when it comes to our temporary or nominal accounts, we're going to basically do the exact opposite. We know that revenue maintains a credit balance. Well, what did I do in order to get a zero balance? Well, I'm going to create a debit for the exact same dollar amount. Well, that'll make my revenue equal zero. And we know expenses normally have a debit balance, so how am I going to make them zero? Well, I'm going to go through and create a credit balance in expenses. And I'm going to do that, and I'm going to create my retained earnings. That's really how I'm going to calculate my retained earnings. If I have a debit to income summary and a credit to retained earnings, that means I made a profit. Good guy, right? If I have a debit to retained earnings and a credit to income summary, that means I had a loss. Bad guy, right? We know that companies have net losses because, well, they go out of business. It's an unfortunate fact of life, but they do. As of right now, that's the total picture. With this information, you're already off to being a very good bookkeeper. We create journal entries. We prepare our financial statements from that, and then we create our financial statements. Now it's going to be interpretation of the financial statements, and we'll get into that. I think it's in Chapter 8, as far as like horizontal analysis and some ratios and cool stuff like that. I want to talk a little bit about. We talked about inventory. When we bought inventory, when you bought inventory from another vendor, we simply debited inventory and we either credited cash if I paid cash or credited accounts payable if I got it on account. But when we talk about inventory, let's keep in mind inventory is probably one of the largest assets a company has. It's also one of the brittlest asset. Because what will happen is, depending on how long you hold on to something, it could become obsolete, right? And that's bad. Obsolete inventory simply means you're not going to be able to sell it for its original intended value. I may have bought a iPhone, make up a number, for $100, and I had the intention of going back through and selling it for $300. Well, pretend something new comes out, like the iPhone X or iPhone 8. Well, the one I originally intended to sell for $300 now is probably really only worth maybe $100. So, or maybe even nothing, right? Sometimes it might be worth nothing. In that case, we have obsolete inventory. It happens all the time. Think about televisions. When I made televisions, we did physical inventory, and when we say physical inventory, that means we go out to the warehouse and we have count teams count everything inside the facility. So we go out and count basically all the pallets, all the storage locations, called storage locations, in everywhere. And what we'll do at this point in time is that, if we find, and we found like black and white TVs. Well, black and white TV, let's be honest, nobody will buy one. It may have a value, a cost, inventory value of $500, right? But in reality, if you would go out and try to sell a black and white TV today, what might you get? $20, $15. So any item that's obsolete, you have to write off that total amount. You've got to write it off, or should write it off, because it's no longer valid and it's not a true asset, because you're just never going to get the funds. Some companies will play with that. They won't write off stuff they should. They create slow-moving inventory reports to identify that. Some do, some don't. They really should. But different companies do different things, but they really should according to GAAP. Anyway. But you have to keep track of your inventory. You have theft. You would not imagine in my various roles how much theft I've seen, especially on electronics. People will carry their coats in and walk out with a DVD player underneath it, or an audio player, CD players, whatever it is. People will go back through and do all this kind of crazy stuff. And you have to account for theft. That's why you have to be very careful. You put metal detectors everywhere. You make sure that people don't bring, you keep their coats and their lunch boxes in its own separate area. They never bring it on the floor. Basically, you never allow people to bring anything in where they can smuggle something out on. I know most people are honest, but not all of them are. So it's something you just really have to be careful of. Unfortunately, the good people get dinged with the other because some people are bad and want to steal. So you just have to be very careful on that. But inventory is really cool. We'll talk more about that probably, I think it's in a future chapter. Big concepts I want you to think about in inventory is cycle count. Cycle count means that every day you get 10 or 15 items, you send somebody out and they count them. They go to the store's location that it belongs, bin location. SAP calls it store's location, or SLOC, SLOC, store's location. You'll go out there to that store's location. According to your inventory, your warehouse sheet, you should have 100 units there. The person goes out and he counts. Do I have 100? Well, if I have 100, life is good. If I have 95, then what will happen? Your inventory person will have to go back through and identify, hey, where did the other 5 go? Did they, what happened to them? So that's something that's really necessary, because either options, right? They never sent to me in the first place, right? The vendor shortchanged me. If that's the case, we go back to the vendor and tell them, hey, look, you need to send me 5 units, or issue a credit memo for the value of those 5 so I don't pay those 5. Could have been stolen. If it's stolen, you need to identify, where the person might be, and put controls in place. Or it could be inadvertently shipped them, but you didn't relieve your inventory. Very much possible. That was one of the big things we found with Philips, is that, audio players, some of them look really, look same, but the people who did the pick, pack, and ship folks, they wouldn't necessarily do a great job of reading what was wrong. So like, had an audio player says AX1234, when they were out picking stuff off the racks, they would maybe pick a AX789. They didn't really pay attention, and they would send the wrong thing. It's a problem, right? Because my inventory of the AX123 is higher, even though it should have been lower. My inventory for the AX789 was lower, it should be higher. Then I have people sending their goods back, and it's like, what happened? What happened here? So you have to be very careful. You need to make sure you have good people in the warehouse who are sending the right thing. All right, that's a recap, and next time we'll do 6, 7, and probably 8. Okay.